The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everybody. This is Andrew Wilkinson, Director of Trading Education with Interactive Brokers. Welcome to today's event, which is brought to you by my guest, Joel Fingerman of Fundamental Analytics over in Chicago. And today, Joel's going to be talking about the summer driving season, and he's going to look at the supply and demand data and issues for gasoline and diesel fuel. And before I hand the mic over to Joel, I just want to point out today's disclosures from Interactive Brokers. I'll leave those up on the screen for everybody to read for a minute. While I go through another couple of pieces of housekeeping. Today's event is being recorded. 2 hours after the end of today's webinar, you will receive a link in your inbox from Interactive Brokers via email with a link to watch the recording in the event that you have to drop off or other reason, or that you couldn't make it in the first place. So welcome to those watching the recording. And if you have any questions for Joel, please type them into the questions pane in the GoToWebinar panel. And Joel will get to those at the end of the session. So Joel, I am about to make you the presenter. Here we go. And you should be able to share your screen. And if you can just share your screen with us again, Joel, we can move to have a look at your website and you can begin the presentation. Welcome, Joel.
Thank you, Andrew. Does my screen show okay, Andrew? Just want to double check with you.
Yep, perfectly. And I think we're ready to learn something about gasoline and diesel issues. Go ahead, Joel.
Thank you. All right. Well, we're going to talk about this since we're just starting into the driving season, an unusual driving season coming after last year's issues with COVID and the whole question of how much demand there will be for gasoline. Andrew and I were talking about this before this webinar, the whole issue of people driving to work. At one point, it was estimated that gasoline demand was based on 80% of that was based on people commuting to work. And if there's a large number of who will no longer be commuting, that will have an impact on demand. And the refiners are indeed concerned about that. Now, as I just showed you, I've went into the, I can back up for a moment just to repeat it. I went into our platform where we have several commodity groups, one of which we specialize in. One of the things that we specialize in is the energy market. And I'll click on gasoline, and it will be talking about fundamental data, price data, and analysis in them. And we default to the prices because with so many of our clients as traders wanting to look at prices, we bring that up. But I'll switch over to fundamental data and switch over to the EIA numbers, which came out earlier today. And we'll then go to the gasoline and look at least start with stocks. I'm going to swing back around to this, but we'll go directly to the stocks and the demand. And there are the various components of the refiner output of gasoline, as you see here. But we'll just look at the total motor gasoline pool and select, again, total U.S. stocks or inventories of gasoline, which are tracked by the government. And once I've gone through all these steps, it gives me the time unit of weekly data, and I'm ready to plot the data. And we see that the gasoline inventories, this is what we call a year-on-year overlay chart, where we're going back back 15 years to 2006. And I can go to any one of these legend years, point to it, and it shows me that data. So this is what happened in 2007, 2008, and so on. And I'm going here then pointing to 2021, and the latest data is shown that came out this morning was for last Friday. As of last Friday the 9th, the amount of gasoline in inventory is 234 million barrels. and we're kind of sitting in the middle of the pack. And notice, just by a comparison, if we look at last year at this time, notice how the inventories were much, much greater than we have at this time. And one of the reasons for that is this was the start of the lockdown, at least certainly in the US. And what that meant was people were not driving to work, so there wasn't a need for the gasoline, and it was basically backing up in storage. And we see there, excuse me, that we got up to over 260 million barrels in storage, which was kind of a record for the last 15 years. Indeed, if I wanted to isolate one of these years, I'm pointing on my mouse to the 2020 year, but if I held the control key down, I'm holding the control key down on my keyboard, and then click on 2020, I then see it individually, and I can back in and add other years, say the current year, and do a comparison. If I wanted to compare back to 2014 for some reason, I would click on that and bring it in the scales accordingly. But since this is time series data, we also have the option of looking at it from the time series perspective. And we do this, and we see, not surprisingly, over the decades, the years, we've been growing amounts of gasoline in storage to manage the growing demand. But as you see also, we peaked much lower than previous years because of the lower demand that's currently happened. And this is, yeah, I'll just leave it at that point. Now, this is the amount in inventory, and I'll go back to the chart of that and bring all the data back. I show the series. And one does notice a certain seasonality to it, because the refiners build up the inventory in the early spring and in anticipation of the driving season, which technically the summer driving season starts in May or June, but it really does once we come out of the winter weather. We see the increase in driving, and we'll see a drawdown on the inventories as the American public uses more than the refiners can actually produce on a given week. And so they depend on what they have in inventory, and they actually depend on imports. It's not a well-known fact that, excuse me, I beg your pardon. It's not a well-known fact that in this country we actually depend on gasoline imports, because the amount of demand for gasoline as the major refined fuel is greater than what the refiners can produce, and so they depend in part on imports. And so you'll see the drawdown, and then it builds back up given into the fall. Now, what I can do is leave this tab here, duplicate it by clicking on this button, and I could also rename these if I like. And now I want to switch to this one, and instead of looking at the inventories, I want to look at the demand for gasoline, which we call the implied demand. And I'll explain in a moment why that is the term used. And that is it's popped to their implied demand. And I want to use finished motor gasoline again, and the total US. Why it is implied is that the numbers that the EIA supplies does not actually give a straight demand number. What happens is they give us numbers for the inventories, the imports, and the production. And if we take the production plus the imports and subtract the change in the inventories, that implies what the demand would be. I could put the little algebra equation up, but I won't at this point. In other words, it's a constructed number. They have something equivalent called product supplied, but that doesn't include other pieces of data which are more useful when we construct it this way. So I set this up, I plot the data, and we see this dramatic drop that occurred last spring of demand because people weren't driving to work anymore at that time. And so it had that huge collapse in demand, and in turn, that was what was causing this inventories to rise. Now, if I can take that out by just left clicking to rescale it to kind of look at the general seasonality of demand, and we do see I beg your pardon. I did not have this cough before the session. Okay, so we see this seasonality of demand sort of peaking in June and July, and the expectation of the refiners is they actually have to plan how much they're going to have online available back in the spring, February, March, April, when they're turning it around to produce the summer grade gasolines. But we have actually a lot of noise, what we call in the data. So our system allows for a smoothing, and I'll just do the simple 4-week moving average smoothing of 4 period. So it again shows you kind of better the seasonality of the demand for gasoline. And notice we're coming off a period where we have some of the lowest demand because again of COVID, the lack of the economics that are driving the demand for gasoline. Now, related to that, which is kind of interesting, let me just bring everything back. A fascinating drop there and how fast the demand came back. Basically by July of last summer, it was starting to come back after some people were figuring out other ways to manage the work schedule. But what I want to do is add another component, and that is I want to look at what we call days forward supply. Now, one really needs to adjust the demand for gasoline relative to the amount that you have on hand. And so you could have a high demand, but if you have very high inventories, then you can manage okay. You could have a low demand, but also by coincidence, have a very low supply availability, which would be a problem for the refiners, given the fact, even if there is a low demand. So what is done is we look at demand and we divide into supply or the inventories, and we get what we call days forward supply. So I'm going to switch this and goes to days forward supply. And again, I'll do the total finished motor gasoline. And this can be revealing. Right, here we let me just do a different way of working this out. I'm actually going to do the division for you. I'm going to add another leg to it and do the total stocks of total motor gasoline, and then look at implied demand and use the finished motor gasoline and total US. And now I'm going to do a division of the stocks by the demand as another way of looking at this days forward supply. And we see here, this is what was very interesting what happened last year. As a result of having no demand and the supply jump up, the number of days that we had available supply was huge as a measure of really that the refiners had more on their hand than what they could use. And this is a similar kind of problem currently that we still, because the demand hasn't come back as much, have on a relative basis a good amount of supply compared to the usual periods. And again, if I would take out last year's outlier, we would see kind of the more typical seasonality of the days forward supply. But even adjusting for that, we see that this year, again, because of relatively lower demand based on the amount of supply, we have a greater days forward supply than one would expect during this period. Okay, now, one would think in turn that would mean that prices would necessarily be lower. But what's been happening is that crude oil prices have been increasing. Part of the reason for that, and I can show you with the interesting information that came out this morning, that the crude oil, I'll go to, I want to be in fundamentals, and I go back to the crude oil fundamentals and the stocks. again, the amount that we have on hand, the refiners to turn into gasoline. Now, the analysts expecting this morning the number, they were expecting about a 3 million barrel draw. In fact, what happened is that there was a 6 million barrel draw. It's not quite as evident here, but if I focus on this, we see that we drew by, oops, I didn't mean to, here we go. We see here that the draw, where we have the change, this is 5.9 million barrels it came down from last week, was unexpected. And as a result of that, the market took a pop, and I think I can bring that up here. We don't have intraday numbers, but there are many sites that do. And I was looking at that earlier, if I can find it. Let's see, I'm not, all right, I'll come back to that later. But the crude oil dropped significantly in inventories, which was relative to, bring all the series back, reset the zoom, which was not expected, and as a result has caused the market to pop. And one of the things that's been causing prices to pop is that inventories have been coming off because of OPEC Plus and others being concerned about that, and prices have been rising. So as prices rise, despite the fact that, let me reset the zoom. What did I do? Let's just reset this. Here we go. Despite the fact that we have less demand for the gasoline and refined products, we have some fairly high inventories, OPEC and others have been trying to hold it down and allow for the prices to rise more. And in turn, that causes the price for the gasoline finished product to go up. One other point I wanted to make about this was, again, the refiners who are coming into this driving season, instead of looking at inventories, let's look at the amount that they're going to be using, which is the amount, I apologize, the amount that they're using in their refining operation, which is the net inputs of crude oil. Now, again, it's just remarkable what happened last spring with COVID, that there was this drop, and the same thing happened recently here, having to do with the cold weather in February and the drop of the refiners not being able to handle it. If I took this out, and we look at last year, we see the same issue with the refiners' input. When the work stopped and people didn't need to drive, the refiners didn't need to use the crude oil to make gasoline. So this collapsed, and it's been, weekly recovering so far this year. And we got hit earlier, though, with the unusually cold weather at the end of February, where the refiners couldn't run the refineries, so they didn't need the input. They're coming back, but again, they're at the lower end of what we normally would have at this time of the year. And again, I like to look at it always from a time series perspective. We saw this huge hit that it took because of the cold weather in Houston and Texas in the refinery operation. They've come back, but still relative to what refineries have been doing up to this point, they are way off because of the demand not being there and the price going higher. Now let's talk about that pricing. So we do have enough on supply. Demand's not quite there yet because of the whole nature of work and how many people will be going back to their offices for regular office routine, if we want to go back and look at the gasoline prices per se, and what we might think or expect or think about the range of the prices, I'm going to bring up the futures contract prices, the RBOB as it's called, and let's just look at, first of all, just a simple high-low close chart of the prices. And so gasoline has been moving up, as we see here. The red bars denote days in which the market was basically down or down from the open. The green bars denote days that's been going up. And basically, since last fall, it's been ratcheting its way up and working its way up. Now, the real point to understand these prices is to look at what we call the margin, or in the lingo of the oil industry, is the crack spread. That is the difference between the price that they can sell the gasoline versus the price of the crude oil that they have to buy to make the gasoline. So that, and it's called a crack spread because it refers to basically a big chemical factory, which is what a refinery is, and their distillation units or fractionation or cracking of the crude oil into these various components like gasoline, diesel fuel, jet fuel, and so on is called a cracking, and so it's talked about as the crack spread. And what we mean by that is here, we're sitting in the May contract. Now, actually, I should push out a little bit to the June, but let's go and we'll duplicate this. Let's look at the June contract. I'll switch to prices specifically and look at what the June contract prices are trading at. And we see the gradual increase in prices that we've seen since last November. This is the current year, what's going on. These are expectations for next year and so on. I'm going to isolate these. All right, let's bring them all back. I'll isolate these, take them off the chart. And this is what we've been doing so far this year. And again, last year, prices collapsed because nobody was driving and they couldn't sell it. This year, it's come back to a certain extent, and the prices have gone up in part due to demand recovering somewhat, also in part due to what the crude oil prices, the raw material from which the gasoline is made. So what we would want to do is compare this with the crude oil prices. I'll use the U.S. domestic contract, and I'll switch to what we call instruments and spreads. And I want the WTI by the NYMEX. And we'll look at the June contract. Once I'm set, I plot this data. And we see we'll take out the futures forwards beyond this front month contract. And so we're sitting here, and as of yesterday's settle, it is telling us that yesterday it settled at $60.24, price of crude oil. Then I go back to the price of gasoline. I see yesterday that the May contract of that's the 12th, I want the 13th. This is, oh, I'm still at the crude oil. I want the gasoline. And I'll take out something around there so I can read it easier. There we go. So yesterday, gasoline was priced and $1.97. So let's say $1.98 rounding up, and versus the crude oil at $60.42. So what that means is I have to change the gasoline, which is priced in dollars per gallon, versus the crude oil, which was priced in dollars per barrel at $60. So it's excuse me, it's roughly close to $2 a gallon for this contract as of yesterday. So $2 times 42 is roughly $84 versus the $60 for the price of the crude oil. So that this crack spread is running at roughly what did I say? $28. We can actually do the simple calculation. See if I can bring it up quickly. So I said the gasoline was at $1.98. And I have to multiply by 42 because that's how many gallons in a barrel. So $83. And I will subtract the $60.24 that the raw material cost. And we see the crack spread at close to $23 a barrel, which is a healthy margin, as I'll show you in a moment. Now, we could have this calculator hang around and do that, but pleasantly enough, we're pleased to say that in our system, you can actually construct this on the fly. So I'm going to duplicate this tab and go back to the data. So here's the crude oil. I'll click add a position. And I'll go switch here to the gasoline for the RBOB. And we'll talk about June. And so again, that would be the $1.98 that was yesterday's settle. And again, like I mentioned, or did on the calculation, I'll have to multiply by 42 to get it in dollars per barrel, and then subtract the cost of the crude oil to get the margin of the refiner working on what they call a one-to-one basis here. So I set this up, I plot the data. And again, it's a little crowded, so I'll take out some of these years, the forwards. Again, we see last year how the crack spread just got clobbered, the margin. In fact, at one point, the refiners were losing money. It was selling at a negative amount. Excuse me. It was selling for a negative amount at that point. But if I focus just for the moment on this year's specifically, and I go to yesterday's settle, there we have it. We see there that that crack spread is the 22.91 that I had done on the calculator. And that's the amount of margin between what it cost the refiners on a theoretical basis, what it would cost them to buy the crude oil on the market where it's priced and sell the gasoline on the market where it's priced. Their margin would be roughly $23. If I bring back and compare, so there's last year where it collapsed. The year before, it pulled out healthy at the end of the contract. 2018 had some wiggles in it and so on. So we're in the kind of the upper range of the crack spread, because in a way, the refiners are holding back as much as they can from buying the crude because they'd like to wait until it prices down. And by doing this, they can lower the amount that they're producing and not limiting supply, but not oversupplying it so that the market is coming back. And one would think there is this notion that people have been very tired of not doing anything, and they really want to get out and start doing things, so that there will be that kind of demand which will also drive up their price and increase the crack spread. So that with the exception of 2013, and offhand I can't recall what was happening in the spring of 2013, which caused the crack spread to jump like that, as it did, but eventually came back, and so on. So we're at a level which is reasonably high. One of the ways that we can check that, compare that, is that because all of these crack spreads, which it calculates just not just for this year, but for each year. So if I look, it'll show me what the RBOB price was at that particular date, what the crude price was, and the calculated crack spread as an example. But my point is that we don't know when we look at these what the underlying prices are. We just know what the finished calculation is. So they're really not comparable. If one year prices were priced very high at $70, $80 versus another year where it was very weak prices and you had $20 or $30 or $40 crude. So what one would do in order to compare them on a relative basis to their crude price at that year, that time, is we'll add another leg. Excuse me. And I want to make a point that we're not limited to 3 or 4 legs, that any complicated formulation of various products and months can be done on the platform with unlimited number of legs or places in the calculation. So what I'll do now is take this 9X crude oil. I want to adjust relative to price. I'll use the June contract. And in this case, I'm now going to divide. And there's my division. And so what this means is I'm taking the crack spread relative to the crude. So it's, I guess you would call it A minus B divided by B. And that way we're adjusting each month, each year to the relative price the crude was at, affecting the crack spread. And by doing that, it's just a double check to see, well, we're in the middle of the range here. Does it make sense from a either pricing or a market point of view that we would be here relative to what the crude price is? And we'll work this out. I don't know what it's going to look like, but what it returns when we've done this calculation, it returns it as a fraction or a ratio, not as any kind of a price. Again, we had the wild year last year, so I'll take that out for the moment. And we see on a relative basis, we're basically still in the middle of the pack. So adjusting for price, we're doing just fine, so to speak. What might happen in the next few days before this contract expires, the June contract will expire in roughly May 20th. So it hasn't become exactly spot at this point, but it's getting close to it. It could, just move along. But relative to price right now, crude oil price, the crack spread compared to others is basically where it should be, quote unquote, given adjusting for the crude oil price. Okay, so what are the things we're finding out? We're finding out that there's enough inventory that crude prices probably will stay firm and impact the gasoline price. So there might be more demand, a little bit more pricing accompanied with that higher demand. And because the refiners are going to be very careful during this season, they don't want to have a lot of leftover crude from the driving season that they don't need, and they have to worry about possibly even excess gasoline that they produce to supply need that just didn't show up in the end. Now, the other piece we want to look at is the diesel fuel, because that's becoming an interesting new phenomena, especially if one thinks of all the deliveries that are happening now with online shopping, whether it's FedEx, UPS, or others. That whole aspect of more driving on a commercial basis for deliveries has become a significant issue in the energy world. So what I'm going to do is switch from the crude oil prices to the heating oil, which is equivalent to diesel fuel, which is what the big trucks and other cars would, especially delivery trucks in those times, are using diesel fuel, which is equivalent to heating oil. As far as home heating per se with heating oil, that keeps dropping. There's probably less than 10 to 15% of the US population actually uses heating oil for fuel for home heating. It's all natural gas or electricity at this point. Speak up. So I bring up the heating oil, and again, I'll switch over to the June contract. And plot the data. And we see again, we actually had more strength in the diesel fuel and the heating oil than in the gasoline, because while the commercial need for gasoline was high, it went down dramatically. The commercial need for diesel fuel went down, but not as dramatically and not as much in this case. But we certainly didn't have negative values. We had low values, but not negative values. And so here we see that price. We can again work out the crack spreads and see where the diesel fuel is relative to previous years. We should also check in terms of the inventories. So I'll go back to my fundamental data. And this time I'm going to look at, instead of gasoline, I want distillate fuel oil. Total inventories, total US. Once we've satisfied that, the time interval shows up and we can plot the data. And so again, we have good amounts of diesel fuel. As you see here, there's a real seasonality, the tendency by the winter months to have fallen off and rebuild into the summer. A little peak here, then it gets used in the fall, coming off. But we're seeing that because of the lack of the commercial demand on a relative basis, we have more in stock than on previous years at this time. And I could look at it from the time series perspective, and we see that it's coming back, and we have more, nothing like what we had earlier last year, but we are coming back in that perspective. So we've got ample supplies, and let's look at the demand. I'll duplicate this. And let me remind the viewers that every one of these tabs has different information. And what we can do is name every one of the tabs by clicking on this editing pencil. All right, come on, let me edit. There we go. And so I could label this as stocks. And so on, and create a series of tabs with names associated that I put in there so that I create a dashboard. And each one of these tabs I can actually save into a library under a system. I go here, I give it the information I want to give it about this particular chart and data. I save it, and I could also add to this. There's a little box here to tick off if you want. And the point of this one is that it allows the user, or has the system, automatically bring up that chart every time you log into the platform. So you don't have to go through the steps to get the data. It's just there and it's set up to run. I'm not going to do it in this point. But once you've saved this into a library, and you have what would call my library here, it shows all the spreads or data that you've saved, and whether it's on automatic default show or not, whether you want to view it and so on. So you create this library of information. And where did I, there, we close this. So then what would happen is you could have it set up to bring out the various tabs that you're interested in your library automatically. And so you could turn on the platform, let it automatically update, and you'd have a half a dozen, whenever, 10, 20. We've known of clients who will have as many as 50 tabs open to watching all the various kind of prices and fundamental data related to it. And it's just pointing out the usage or the way one navigates around it. Okay, I was going to mention demand for the fuel. Once we've got the intervals and it shows, oh wait, one last piece, the total US. Now the intervals are shown, and we plot the data. And again, in this case, it's much noisier, so to speak, because of the way it's counted week by week. But notice, we did have a problem last spring, but not nearly as significant as what happened to the gasoline demand and the amount on hand. And again, since this is noisy data, I can smooth it, looking for general seasonality. In years past, you would have definitely a winter-summer season for diesel fuel, that the fall would be the higher prices and the higher demand. And then in the summer, the prices would weaken. Well, that was all based and primarily with home heating. And since home heating has gone away, what has been the major driver in demand for these products is that it now is more just consistently into a range of demand, so that you have all year round deliveries by UPS, FedEx, and so on. You don't have the seasonal ups and downs, with home heating being not needed in the summer, and it, can be extremely needed in cold weather winter. So you have that, the supply and price seasonality, which is now going away because it's a year-round kind of product for trucks and planes. That's the way they're set up. Planes use a form of diesel fuel. It's actually kerosene called jet kerosene, which is another form of diesel fuel that the refiners make. Okay, and then lastly I could bring up is how one would compare. Well, we don't really need to in this point, but one could compare these price of gasoline to the price of diesel, because in a way they're considered competing products. And I bring up my gasoline, and I go to instruments and spreads, and I bring up another position or leg. Again, we'll focus on the June contract. And it's often traded this way, and it's of concern to traders, is the difference between the price of the heating oil or the diesel fuel versus the price of the gasoline. And so we would take the difference between those two. So I'll take heating oil minus gasoline. There's all sorts of wonderful jargon in this business. And heating oil was abbreviated HO, no surprise. Gasoline, originally when it was traded, was abbreviated HU. So you had HO versus HU in price differential. And that was called the HOHU spread between those. And that shows you that some traders have too much time on their hands, and so they come up with these crazy names for products and spreads. And here we have the June contract, the heating oil versus the gasoline. And again, these all you construct on your own, set them up, and they work accordingly. Now, notice again, last year, what happened with this heating oil versus gasoline. Since gasoline just collapsed in price, the heating oil price was dramatically higher than the gasoline price because it didn't collapse as hard. Now we're seeing kind of the reverse play, where the gasoline is rising faster in price than the heating oil. So we have a negative spread at this time because it's HO minus gasoline. So to get a minus value, you're going to have the gasoline be larger than the heating oil price. So we go there, we can get the whole price. There we go. I get it. Yeah. So again, as of yesterday, the heating oil price was $1.81. The gasoline price was $1.97. So it's showing us that the gasoline is rising faster than the heating oil. So the spread between those two has gone negative and probably will continue to be negative as the trend tends to be. One of the things I've noticed about looking at prices of these commodities, and I don't have specific statistical evidence, but one thing I've found is that it's not necessarily the case that prices are mean reverting, that if prices go way out of whack now. This certainly happened here, and we can see afterwards that it came back. But you can imagine a trader saying here, well, boy, it's gotten this high, it can't get any higher. I think I'm going to sell it at this point, and then the price, in fact, goes up. So you have to be very careful. If prices are out of whack and if demand is out of whack, it doesn't mean it's going to revert back to something normal. It usually means that it's going to get worse before it gets better. So I leave on that kind of happy note, but I wanted to make the point that these prices will probably firm up, the gasoline faster than the diesel fuel. This is just a seasonal assumption. I'm not making any predictions per se, just looking at the structure of things. That's what it would suggest, in my opinion. Other than that, I'll let it go at this point. And Andrew, if you want to take over from here.
Thank you very much, Joel. A fascinating insight into supply and demand issues for gasoline and so on. I did ask the audience if we have any additional questions for Joel. So please use the chat panel, the question panel rather, to enter any questions. And in the meantime, I just want to remind people that the PDF handout provided by Joel at Fundamental Analytics is available also from the GoToWebinar panel there. If you look in the handouts panel, you can expand it and download the PDF. And we will display this. Joel, should we put this onto the IBKR YouTube channel later this afternoon as well?
That's fine, sure.
Yep, okie dokie. So you can reach the recording there at any time, and we'll ping you all with an email later on this afternoon. Joel, thanks so much for joining me. We've got no additional questions from the audience at this time, so we're going to wrap up. Thanks for joining me, and hopefully we'll speak to you next month.
Thank you, sir. It's been a pleasure.
All right. Thanks, Joel. Thanks, everybody. Bye-bye.